Why the Propfirm account you're buying might be the worst investment of your trading career. A guy named Randy spent $2,500 trying to pass Propfirm challenges. He finally got a $100,000 funded account. He made $8,000 in profit. He felt like he'd finally made it as a trader. Then he did the actual math. Randy, retail trader, struggling with a small $1,000 account. He sees the YouTube ads everywhere. Trade our capital, keep 80% of profits. It sounds like the answer he's been looking for. He buys his first 100K challenge for $500. Fails on max drawdown, day 43. The rules got him. He retries. Fails again and again. 4 more times over 8 months. Each time, $500 gone. Each time, he tells himself he's getting closer, learning the rules, getting better at the game. Month 8, attempt number 5, he passes. Both phases. Clean. He gets the funded account. Randy starts trading it. Real money now. Well, their money. But it feels real. He makes $8,000 in profit over the next 3 months. Gets his first payout, $6,400. That's his 80% split. He screenshots it, posts it. His friends congratulate him. His family finally stops asking when he's going to get serious about his career. Randy felt like he'd finally made it. Like he was a real trader now. He felt like he had won. Then, Randy's trading mentor asked him a simple question. What would have happened if you'd just traded that $2,500 in challenge fees? Randy had never calculated it. Nobody does. The Propfirm model doesn't encourage you to. So he sat down and ran the numbers. The number that came back made him sick. And by the time I finish showing you what he found, you're going to understand something about prop firms that most traders spend their entire careers never figuring out. Something that changes how you evaluate every single funded account offer you'll ever see. My name is Nick, and I'm the Insides Trader. When I was working as a data analyst for a prop firm, I had unrestricted access to the backend servers. Not the marketing pages. Not the success stories they post on Instagram, the actual raw data. I analyzed thousands of trader accounts, the ones who passed, the ones who failed, the ones who got funded and lost it in week 2, the ones who made 6 figures, all of it. And I found something the industry doesn't talk about. There's a mathematical difference between the 1% of traders who get massive payouts and the 99% who blow their accounts. And it's not what you think. It's not strategy. It's not win rate. It's not even discipline in the way most people talk about it. It's something that happens before you ever click buy on a challenge. It's whether you should be buying one at all. I've spent an unreasonable amount of time running the numbers on the thing that most traders treat as an unquestionable truth. Prop firms are the only way to scale without capital. You've heard it your entire trading career. Every YouTube ad says it. Every funded trader on Twitter says it. Every trading influencer with a discount code says it, with the confidence of someone reciting the law of gravity. If you've ever bought a prop firm challenge, or you're thinking about it, or you're trading funded and wondering if you made the right call, subscribe. Because by the end of this video, you're going to have the actual math to evaluate whether a prop firm is accelerating your trading capital or quietly destroying it. And what you find might genuinely surprise you. Let's start with where the belief came from. Because it's not wrong, exactly. It's just missing about 5 years of context. The idea that prop firms give retail traders access to institutional capital is not complete mythology. It has real roots. Traditional prop trading firms, the real ones, SMB Capital, Jane Street, T3 Trading, those were legitimate operations. They recruited talented traders. They provided training, mentorship, real capital, sophisticated infrastructure. They kept 20 to 30% of profits because they were taking real risk on real capital. That model worked. Those traders built real careers. Then, between 2018 and 2022, something shifted. A new category emerged: retail prop firms, challenge-based funding, evaluation fees, simulated capital during testing phases, profit splits that went from 20% to the firm up to 50% to the firm in some cases. The business model was completely different. Traditional prop firms made money when their traders made money. Their revenue came from market profits. Retail prop firms make money whether you pass or fail. Their primary revenue stream is not trading profits. It's evaluation fees. It's monthly platform fees. It's reset fees. It's the $500 you pay to try, and the $500 you pay to try again. But here's the problem. The pitch stayed the same. Trade our capital, no personal risk, keep most of the profits. The conclusion got separated from the conditions that made it true. The prop firm model of 2015 is not the prop firm model of 2025. The revenue structure is different. The capital deployment is different. The risk allocation is different. The pass rates are different. But the slogan stayed the same. Pass down like gospel, without anyone checking whether the math still works for the trader. Here's what prop firms actually cost. And I'm not just talking about the evaluation fees. I'm talking about the cost that nobody calculates until it's too late. The psychological cost. Let me show you what I mean. Randy traded his own $1,000 account for 6 months before buying his first challenge. In those 6 months, he had a strategy. It wasn't perfect, but it worked. He took 4 to 6 trades per week. He held swing positions for 3 to 5 days. His win rate was around 52%. His average risk to reward was 1 to 2.3. It was slow. It was boring, but it was net positive. Then he bought the challenge. Suddenly, there were rules. Daily loss limits, maximum drawdown percentages, minimum trading days, profit targets with time limits. His strategy didn't fit inside those rules anymore. A 5-day swing trade? Too risky. If it went against him on day 1 and hit his daily loss limit, challenge over. A 1 to 2.3 risk-to-reward setup? Not aggressive enough. He needed to hit profit targets faster to pass phase 1 within the time limit. So Randy changed how he traded. He started taking more trades. Shorter time frames, tighter stops. He started closing winning trades early to lock in progress toward the profit target. He started avoiding trades he knew were high probability because the drawdown risk was too high during the challenge. He wasn't learning to trade better. He was learning to pass challenges. And here's what I saw in the backend data that nobody talks about. Traders who pass prop firm challenges have a completely different statistical profile while in evaluation mode than they do when trading their own capital. Their trade frequency increases by an average of 64%. Their average trade duration decreases by 40%. Their win rate drops by an average of 8 percentage points. They're not trading their strategy anymore. They're trading the prop firm's game. And when they get funded, here's what happens. They try to go back to their original strategy, the one that was actually profitable. But now there are still rules, still daily loss limits, still drawdown percentages that can reset their account to 0. So they keep trading scared. Randy closed winning trades at 1-to-1 because he was afraid of them reversing and eating into his progress. He avoided trading during high-impact news because one wrong move could trigger his daily loss limit. He watched a perfect setup form on his main strategy and didn't take it because the stop loss required would have used 40% of his daily allowable risk. The skills that pass prop firm evaluations are not the same skills that create long-term profitability. Let me say that again. The skills that pass prop firm evaluations are not the same skills that create long-term profitable trading. You're being trained to operate inside a risk framework that doesn't exist anywhere else in trading. Not in your own account, not in a hedge fund, not in real institutional trading. You're learning to pass tests. And the cost of that is not just the $2,500 Randy spent on challenge fees. It's the 8 months he spent ingraining habits that don't transfer. It's the psychological conditioning to trade for rules compliance instead of trading for profit. It's the opportunity cost of not spending those 8 months building real equity in an account he fully controlled, with no one watching, no rules to follow, and no reset button. When Randy finally sat down and did the math, here's what he calculated. Evaluation fees over 8 months, $2,500. Profit from funded account over 3 months, $8,000. His payout at 80% split, $6,400. Net return, $6,400 minus $2,500 equals $3,900. That's what he made, on paper. But here's what he didn't calculate until his mentor asked the question. If he had taken that $2,500 and deposited it into his own account over those 8 months, trading his actual strategy, the one that worked before the Propfirm rules changed it, where would he be? At his original 52% win rate, 1 to 2.3 RR, taking 4 trades per week, risking 2% per trade on a growing account balance, that $2,500 would have compounded to approximately $3,411 over 8 months. Not a massive difference, right? Except he would own the $3,411. No profit split, no rules. No one could reset it to zero. And more importantly, he would have spent 8 months building his real edge, not learning to pass someone else's test. That's the cost nobody puts on the sales page. Quick favor before we go further. If this is landing differently than what the YouTube ads told you, hit the like button. It tells the algorithm that traders want the real math, not just the success stories. Now let's talk about the most important cost. The one that never appears on any Propfirm dashboard. The one that never gets calculated at any checkout page. The opportunity cost of the money you spent trying to get funded. Randy spent $2,500 on challenges over 8 months. That $2,500 went into evaluation fees. It stopped being tradable capital. It stopped compounding. It became a sunk cost, with the hope that passing the challenge would make it worth it. But here's the alternative universe. What if Randy had taken that same $2,500 and deposited it into his own trading account instead? No rules, no daily loss limits, no profit targets, no one watching, just him, his strategy, and the market. Let's run the actual numbers. $2,500 deposited over 8 months. That's roughly $312 per month. Trading his original strategy. 52% win rate. 1 to 2.3 risk to reward. 4 trades per week. 2% risk per trade. Conservative estimate, accounting for losing months and drawdown periods. 3% average monthly return. After 8 months, that $2,500 would have grown to approximately $3,163. Now, Randy made $6,400 from his Propfirm payout, which is more than $3,163. So on the surface, the Propfirm looks like the winner. But we're not done yet, because there's a cost that's invisible until it happens. The reset risk. Randy's $8,000 profit on his Propfirm account exists only as long as he doesn't hit maximum drawdown. One bad week, one news event he didn't see coming, one string of losses, and that account resets to zero. Not a drawdown, not a temporary setback. Terminated, gone, start over. In his own account, a bad week means his $3,163 drops to $2,800. It's painful, but it's still his. He can trade it tomorrow. He can rebuild it next week. No one takes it away. That difference is not on any Propfirm's marketing page. In your own account, you own the infrastructure you're building. Every dollar of profit is yours, permanently. No split, no withdrawal rules, no terms of service that can change mid-month. The Propfirm model gives you leverage, but it gives you conditional profit. Profit that exists only while you maintain compliance. Your own account gives you ownership, permanent equity, unconditional profit. And here's what I found in the backend data that made me walk away from Propfirms as the default path for undercapitalized traders. The average funded trader loses their account within 4.7 months of getting funded. Not because they're bad traders. Because one drawdown period, the kind every profitable trader experiences multiple times per year, triggers the maximum drawdown threshold and the account gets reset. All the progress, gone. All the challenge fees spent to get there, sunk cost. And the trader is back to square one, deciding whether to buy another challenge or finally start building their own account. Randy made $6,400 from his prop firm, but he was one bad week away from making $0 and starting over. If he'd built his own account, he'd have $3,163 that no one could take away, and the psychological freedom to survive drawdown periods without fear of termination. That's the opportunity cost. Not just the money, the time, the mental conditioning, the infrastructure you didn't build because you were renting someone else's. Let me show you the side-by-side comparison that nobody runs before buying their first challenge. 12-month comparison. Same trader, same strategy. Two different paths. Path 1, the Propfirm route. Months 1 through 6. Randy buys 3 challenges at $500 each. Fails all 3. Total spent, $1,500. Month 7, buys 4th challenge. Passes phase 1. Month 8, passes phase 2. Gets funded with $100K account. Months 9 through 12. Trades the funded account. Makes $6,000 in total profit. Receives $4,800 in payouts after the 80-20 split. Total fees spent, $2,000. Total payouts received, $4,800. Net position after 12 months, $2,800 profit. Account status, not his. Subject to rules, can be terminated on next drawdown. Path 2, the self-funded route. Months 1 through 12. Randy takes the same $2,000 he would have spent on challenge fees and deposits it into his own account over 12 months. Roughly $167 per month. He trades the same strategy, same risk management, same setups. At a conservative 3% average monthly return, accounting for losing months and drawdowns, his $2,000 in deposits compounds to approximately $2,456 after 12 months. Total deposited, $2,000. Account balance after 12 months, $2,456. Net position, $456 in profit, plus he owns a $2,456 trading account. Account status, his. No rules, no one can terminate it. He can withdraw anytime. He keeps 100% of all future profits. On the surface, the Propfirm path looks better. $2,800 versus $456 in profit. But let's extend the timeline. Month 13, Randy, on the Propfirm path, has a bad trading week. Hits his max drawdown, account reset to 0. His $6,000 in total profits? Gone. His progress? Erased. He's back to deciding, buy another challenge for $500 or walk away. Randy, on the self-funded path, has the same bad trading week. His $2,456 account drops to $2,100. It hurts, but it's still his account. He can still trade it tomorrow. The profit he made in months 1 through 12 is still in there. No one took it away. Months 14 through 24. Propfirm Randy buys 2 more challenges. $1,000 spent. Passes on the second attempt. Gets refunded. Makes another $4,000 profit over the next 6 months. Receives $3,200 payout. But then, month 22, another drawdown period. Account reset again. Total fees over 24 months. $3,000. Total payouts over 24 months. $8,000. Net. $5,000 profit. But account resets. 2. Current funded status. Lost. Self-funded Randy keeps depositing $167. After 24 months, he's deposited $4,000 total. With the same 3% monthly average, his account is now worth approximately $5,629. Net profit, $1,629. Total account value he owns, $5,629. No resets, no rules, no one watching. Here's where it gets interesting. Month 25 and beyond, self-funded Randy stops depositing. His $5,629 account continues compounding at 3% monthly. By month 36, his account is worth over $10,000. He owns it outright. He can scale his position sizes. He can withdraw profits without asking permission. Propfirm Randy is still in the cycle. Pass, trade, reset, buy new challenge, repeat. The crossover point, where the self-funded path overtakes the Propfirm path permanently, happens somewhere between month 18 and 24, depending on how many times the Propfirm account gets reset. And that's the math nobody shows you. Now I'm going to give you the one number that tells you whether a Propfirm makes financial sense for you specifically. It's called the Propfirm break-even point. And once you know how to calculate it, you'll never look at a challenge offer the same way again. Here's the formula. Total challenge fees divided by your average monthly profit times your split percentage equals months to break even. Let's run it for Randy. Challenge cost, $500 per attempt. Attempts before passing, 5. Total fees, $2,500. Randy's average monthly profit on the funded account, $2,000. His split, 80%. His monthly take after split, $1,600. Break-even calculation, $2,500 divided by $1,600 equals 1.56 months. So Randy needs to trade profitably for 1.56 months on the funded account just to break even on what he spent to get there. That's if he doesn't get reset. If he gets reset in month 3, he made a profit, but then lost it, and now he's back to buying challenges. Here's how to use this. If your break-even point is under 2 months, and you have a proven track record of 6+ months profitability, the Propfirm might make sense. If your break-even point is over 3 months, or you don't have a proven track record yet, you're paying a significant premium for access that might not return what you're investing. Now let's run a more realistic scenario for most traders. Challenge cost, $500. Realistic attempts before passing, 4. Total fees, $2,000. Average monthly profit for a newer trader, $800. Profit split, 80%. Monthly take, $640. Break even, $2,000 divided by $640 equals 3.1 months. And that's assuming no reset within those 3.1 months. If you get reset in month 2, you're back to 0, and the calculation restarts. Here's the decision matrix. Buy a Propfirm challenge if you've been profitable for 6+ consecutive months in your own account. You can pass in 1 to 2 attempts realistically, you understand the rules completely, and can trade your real strategy within them, you have an emergency fund, and aren't gambling with capital you need, and your break-even point is under 2 months. Build your own account if you're still learning and refining your strategy. You've failed multiple challenges already. Your win rate is inconsistent month to month. You need the freedom to trade without daily loss limits and drawdown rules. Or your break-even point is over 3 months. The irony that nobody talks about, the traders who are undercapitalized, the ones prop firms market to most aggressively, are the same traders who statistically should not be buying challenges yet. If you can't build a $2,000 account to $3,000 over 6 months, you're not ready to trade a $100,000 Propfirm account under strict rules. The Propfirm doesn't fix your trading. It magnifies it. If your edge is weak, the rules will expose it faster. And speaking of what separates the traders who succeed from the traders who don't, here's something most people will never get access to. When I was working as that Propfirm data analyst with unrestricted access to the backend servers, I didn't just look at pass rates and profit statistics. I analyzed the raw data of thousands of consistently funded traders. The ones who didn't just pass once and get reset. The ones who stayed funded for 12, 18, 24 months. The ones who made 6-figure payouts. And I found the exact mathematical difference between the 1% who get massive payouts and the 99% who blow their accounts. I took all of that classified data, the kind of information prop firms don't publish, and I put it into a book. And it gives you 3 massive advantages you can't get anywhere else. Here's exactly what you get inside. First, the unrestricted server data. I lay out the exact number of pairs the top 4,000 funded traders actually trade. Not what they say in YouTube videos, what the data shows. Their real trading frequency. Their real win rates. Their real risk-to-reward ratios. Their actual daily loss limit usage. their trade duration, their profit factors. All of it. The patterns that separate funded traders who last 2 months from funded traders who last 2 years. Second, mechanical control strategies. This isn't motivational. This is practical, step-by-step rules to physically force patience into your trading, control fear when you're in drawdown, and stop overtrading dead in its tracks. The kind of strategies the top 1% use that don't require you to be more disciplined. They require you to follow a system that makes discipline automatic. Third, the step-by-step survival guide. You get the exact mindset shifts the top 1% of funded traders use to survive drawdown periods without getting reset. Written in clear, easy-to-read lessons you can apply to your very next trade. Not theory. Execution. It's time to mechanize your mind and take what's yours. Grab your copy of the book through the link in the description right now. Now, here's where I push back on my own argument. Because this video is not a case against prop firms. It's a case against the unexamined assumption that prop firms are always the best path for undercapitalized traders. Those are different things. And there are real, legitimate reasons why a prop firm might be the right call, and I need to be honest about them. First, leverage. If you're genuinely consistent, if you can pass a challenge on the first or second attempt, the leverage is real. You're controlling a $100,000 account with a $500 entry fee. No bank will give you that. No brokerage will give you that kind of margin on Forex or futures without significant capital requirements. If you have a proven edge, and you can operate within the rules without changing your strategy, that leverage accelerates your scaling timeline in a way that self-funding cannot match. For that trader, the profit split is absolutely worth it. Second, forced discipline. For a lot of traders, the external structure of prop firm rules is exactly what prevents them from blowing up. Daily loss limits stop revenge trading. Drawdown thresholds stop martingale position sizing. Profit targets create focus. The challenge process weeds out gambling behavior. And here's the truth. If you can't pass a prop firm challenge, you probably shouldn't be trading large size anyway. The challenge is a filter. Sometimes that filter saves you from yourself. Third, capital efficiency. A $500 challenge fee versus a $10,000 account deposit to trade meaningful size. That's a $9,500 difference. If you can maintain funded status for 12+ months without getting reset, the ROI is undeniable. Some traders make $50,000, $100,000 plus per year from prop firms. For them, the model works exceptionally well. The question is not whether prop firms work. They clearly do, for some traders. The question is, are you statistically likely to be one of those traders? And if you're not sure, the math I just showed you will tell you. So here's the reframe I want you to take from this video. Not that you should never buy a prop firm challenge, but that you should know what you're actually buying. You're not buying capital access with no risk. You're buying a high-stakes evaluation with a profit-sharing agreement attached. Sometimes that's worth it. Sometimes it's the most expensive way to learn you weren't ready yet. Randy doesn't regret his prop firm journey. He learned discipline. He proved he could follow rules under pressure. He got a payout, but he stopped calling it trading with no risk because he risked $2,500 and 8 months of his trading development. That's not nothing. And pretending it is, that's where the math goes wrong. The difference between a prop firm being your best decision or your worst decision comes down to one thing. Are you buying it because you're ready to scale a proven edge, or because you're trying to skip the part where you prove you can be consistently profitable? One of those is a business decision. The other is a lottery ticket. And the prop firm industry can't tell the difference, but you can. Here's what I want you to do before you close this video. Calculate how much you've spent on prop firm challenges in total. Look at your total payouts received. Subtract fees from payouts. Now ask yourself, if I had put those fees into my own account and traded the same strategy, where would I be right now? That's 5 minutes of math that most traders avoid forever. Do the 5 minutes. Your future funded account, or your future self-funded account, whichever one you choose, will thank you for running the numbers first. If you want to know the exact psychology that makes traders fail challenges and how to fix it before you spend another dollar, check our channel.